The biggest lie about stock investing is that diversification makes you wealthy. It doesn't. It keeps you safe. And if you want generational wealth, you need a different playbook. Here's what I mean. If you're playing the buy a little bit of everything game, you might be fine, but you're guaranteed to stay average. I'll show you why diversify and chill caps your upside, the real reason not diversifying feels risky and why it isn't, the simple playbook to find exceptional stocks fast. I'm Jack, and I've spent 2,500 hours learning how the world's best investors do this and turning it into systems that busy professionals can put in place within an hour a week. Let's crack in. The lie sounds smart because it works for the wrong goal. If you've been told diversify, dollar cost average forever, and just buy index funds, that's genuinely solid advice, but it leads to financial security, not wealth. But you've clicked because you want something different. You don't want to just be, I should be okay in 30 years' time. You want, I can quit my job money, I can look after my kids, and I can hopefully look after their kids as well. Now, the villain here isn't index funds. It's this bait and switch between giving us security and calling it wealth when it's not. Now, let me put the numbers to this. So the average index fund path is roughly 8% a year. We start with $10,000, give it 30 years, and we end up with about $100,000. Now compare that to what the best investors have shown is possible. Warren Buffett has averaged about 20% a year for roughly 60 years. And Buffett will tell you this, the more money you have to invest, the harder it is to keep those returns. As you get bigger, the harder it is to make that kind of amount. And that's why the little guys like us actually have the advantage. The result here is that's 23 times more, or $2.2 million more. We want to think of these as two different investing paths. We've got path one being the sure thing of security, and that pretty much is us spreading our money out across everything. We automate it, we ignore it, and we get market returns. It just is what it is. And then we've got path two, which is wealth. And we focus on a small number of exceptional businesses. We reduce uncertainty, we can control the upside, and then let compounding do its thing. Now, here's the uncomfortable truth. The path that's the easiest is always the one that it leads to being average. So I like to think of this as well, a bit more like our basket and eggs analogy. So path one, security, is literally getting 500 eggs, doesn't matter what they are, putting them everywhere, and then putting our head in the sand for the next 30 years, okay? Path two is we go out and we find our best 5 to 10 eggs, and then we watch them like a hawk. Now, before you say, well, this kind of sounds risky, good. You're actually thinking for yourself, and that's what you need to do, because this is where most beginners get the whole game backwards. Now, if you just said, hey, Jack, I've tried investing in individual stocks and I lost a heap of money, or it just didn't work. Hold up, you're not alone. But it's not because stocks is gambling, and that's what I thought when I was first starting out. It's because you are missing something that makes it low risk, and that's what we're about to get into. Why diversify equals wealth survives, and why it keeps you broke. Now, this lie survives for three main reasons. It's easy to teach, it's hard to mess up, and it protects people from themselves. And most people need that. They don't want to learn, they want a set and forget system. And the price they pay for set and forget is mediocrity at best. And it completely caps the upside. Now here's the real trade. Security strategies aim for fewer mistakes, less blow-ups, and less emotions. While wealth strategies aim for better decisions, better businesses, better prices. And you can't get wealth outcomes while playing the game of security. Now this is the crucial distinction. Diversification is a tool, but it is not a substitute for knowing what you own, knowing why it wins, knowing what could break it, and knowing what price makes sense. And that leads to the alternative. Now, a quick one, because you're taking this seriously, there's a link in the description that has a free resources that I've put together that'll help you with this playbook that we're talking about now. And there's another option if you'd like to work with me. Each week I open one client spot, helping one busy professional become confident stock investor in 12 weeks. I've distilled 2,500 hours into the only 40 hours that they need. And if you would like that spot or to learn more, click that link in the description. All right, now here's the actual method. The alternative is not YOLO, it's focus plus risk control. Most people hear focus and think concentrated portfolio and it equals high risk. Now, that's only true if you confuse volatility with risk. So, what's volatility? All volatility is a measure of how high and low the stock price goes over a period of time. So, if a stock price that jumps around a lot, it has high volatility. And if it's very steady and it doesn't really change a lot, it's considered to have low volatility. Now, what we actually care about as individual investors is permanently losing our money. That's the risk. Now, a stock can be volatile with high volatility and have very low risk of us losing our money. But yet, most people confuse the two between high volatility or low volatility and infer that it's a less or high risk investment. So the real risk control isn't just owning 500 things. It's we want to own a great business, sensible prices, with a margin of safety, and have a process for monitoring and making decisions. Now here's a simple focus framework that you can actually do. And here it is in plain English. Number one, find the best investments. We do that so we're reducing uncertainty and then we're filtering out the junk. Two, make sure they play nice together. We don't want to buy 5 versions of the same bet. You want different kinds of winners. 3, watch them like a hawk. You monitor the business, you monitor the thesis, so the idea and the reason why you bought it in the first place. And you protect the downside. Now you can see that this isn't gambling on stocks. This is a specific system and it's business-like in nature. And this is by owning businesses on purpose. Okay. And if you're there thinking, awesome, Jack, but how do I do that? And how do I do it without actually wasting 4 hours of my life reading 100-page annual reports, which are going to actually send you to sleep? It's perfect, because that's exactly what I'm going to show you now. After working with a number of other stock investors that have been down this path before, here's where they always fail. It ends up being one of these 3 areas. Either they don't have a proven strategy, and so they don't have a repeatable process or the knowledge to be able to put this into place. They follow random tips from their mates, or they look online and they follow hype. 2 is competence, where they may have the knowledge, but they have absolutely no idea how to actually apply it in the real world. They don't have the skills and they don't have the experience, and they haven't either taken the time to build that up or to learn it and apply it properly. So the third one is rational action. So you can have a proven strategy, have all the knowledge that you need. You can have the competence and all the skills and experience, but as soon as something actually happens in the market, like a stock market crash or something like that, they lose the plot and their emotions take over. They're not prepared for it, and then they hand all those returns back to the market. And they panic, they chase, and then make those mistakes. Now you can see why you need all 3 of these to work together. Otherwise, it won't work at all. And it's kind of like a 3-legged stool. If one of those legs is missing, the stool will just fall over. Now I'm going to walk you through the proven strategy. And busy professionals, like I said, we're applying it with 1 hour a week. Here's the proven strategy. I call it the 5S framework, and it's a filter. It's designed to save you time, and it's designed to keep you out of trouble. First tip is scout. We want to look for where the great stocks hide. Now, our first job isn't to try and value the business. It isn't to read 100 pages of annual reports and look at them for the last 10 years. We just want to find businesses that we understand. And so Warren Buffett calls this his circle of competence, and it's what keeps him out of trouble. Now, if you don't already have it written down, what you understand, I have a worksheet that helps everyday people work out businesses that they know by their own experience. So if you'd like that, link in the description as part of that free stuff. So if you don't understand a business and you don't understand how it makes money, don't touch it. Move on. Step 2, separate. It's a 5-minute filter. This is our first pass. Now, most people will be like, I want to learn how to read an annual report. No, we're not going to read the entire annual report. We want to make sure we skim through it. Reading an annual report is boring as batshit. Now, instead, we want to make sure we run this quick filter to make sure we weed out the majority of businesses that don't warrant our attention. Now, in 5 minutes, we should be saying things like, hey, this is interesting, or nope, this is going straight in the next pile. Step 3, we want to stalk. So this is our 60-minute filter. And now we just want to go deeper on that same business and really do our homework on it. And so we want to find the few businesses that are able to survive over a long period of time. Because we don't want to find a business and then have to sell it in a year's time. We want to find businesses that will be exceptional over 10, 20 years' time. And that way, once we do some hard work up front, that investment's done and we can hold it. Now we're looking for things that will make it last for that long. And these are the real advantages that hold that business together and make it more exceptional than its competitors and crush them into the ground. So we want to find evidence of that. We want to find great managers that have the right incentives, and we want to find businesses that have shown evidence that they're already starting to compound. Step 4 is size. And this is where we want to size up the business. We want to value it. And we also want to come up with a margin of safety. In effect, all we want to do is come up with a buy price. But how do we do that? Really, we're trying to look at the work that we've done so far is to find consistent businesses that will be great into the future. Then we can be more certain of where they'll be in the future. But still, it ain't perfect. And we want to be vaguely right, especially on the direction, rather than precisely wrong and have everything out. Now, what we do is we come up with that valuation for the business, and then we want to apply a margin of safety. So depending on what we've seen after doing our homework in step 3, we'll have an understanding that, hey, this business is one of the best positions that this company could ever be in. Where's it going to be in the future? What are the risks that might affect it in the future? And so based on those risks, we'll ask ourselves for how much extra or how much of a discount are we going to apply to our buy position. Say, for instance, we come up with a valuation of $100 for a share of that business. Then the business is currently trading at $120 for the business. Well, our valuation is lower than the price, so we're not going to buy. But we add our margin of safety. And so we might say and come up with a value that says, I need 20% less than its value. So we take it back to $80 per share. We have a look at this and then we go, sweet, that's our buy price is $80 per share. Now, cool, we're just going to hang out and effectively do our next step. Step 5 is strike or track. We need to make a decision, and then we also need to look at how we maintain. Now, if we've made it all the way through these filters or steps up to this point and we haven't bought, most people that buy individual stocks have already bought. They haven't taken these steps, and that's what keeps us safe from making mistakes and losing money. Now, it's these steps as well that lead us to find greater investment opportunities that lead to outsized returns. Now, we haven't bought yet. We need to make a decision based on what we've already got in our portfolio. We want to make sure that they play together, like we've said, and this is called correlation. We want to make sure that, is this business that we're about to buy, is it better than what I already own? And if it's not, we really need to hold that standard. If we don't, what we do is we end up diluting and bringing in businesses that are just pretty ordinary, mediocre. And over time, that reduces our return. Now, we use checklists to keep ourselves honest and rational. And we do that to make sure as well that we document part of it. So in 12 months, 2, 3, 10 years time, we can go back and have a look at our original idea and go, that's why I bought that business. Now, by holding those standards and getting to that stage, if the stock price is above your buy price, we don't buy it. We wait patiently, and if it does dip below and present a buying opportunity, we can grab that checklist, bring it back out, and then recheck the business before buying in the future. So let's close the loop. The biggest lie in stock investing is that diversification makes you wealthy. It doesn't. Diversification makes you safe. But wealth usually comes from focusing on exceptional businesses, controlling the risk the right way, and running a simple system that keeps you rational. If you want those free resources, the link's in the description. And now that you understand the lie, you should watch this next. It's how to find the top 1% stocks. Because if you've been playing this game with diversification and set and forget, you really need to take these next steps to work out how to spot these great investments. And it takes this 5S strategy and puts it on steroids. Now, in this video, I'll show you how to apply those filters for getting rid of the 99% of stocks so that you can find the top 1%. I'll see you there. Get after it. Cheers.